Okay, so here we go. This is the last video I'm going to do for this chapter, and this is where we get to the explanation of how the world of finance and portfolio theory has come up with a way to do a somewhat better job in evaluating stock prices than the dividend models that were, given in the last chapter, which we really didn't go over. And so for this whole chapter, chapter 8, we've been talking about risk and what risk means in terms of investments and how we measure risk, how you can measure the risk of historical returns on particular stocks and securities in general as their standard deviation, and how you can then turn around and try to look forward to look at risk in terms of expectations for the future movement of a stock price and the cash flows associated with it. And then we talked about the relationship between expected returns and risk going forward, because it is a truism that investors want to maximize returns and minimize risks, and that leads us to this idea that if two assets have the same returns and one has lower risk than the other, then you would prefer the lower risk asset. And then we talked about how diversification and a fully, well-diversified portfolio can get rid of a lot of the risk in your portfolio. It can get rid of all the unsystematic risk, but you're still left with the systematic risk, which is the risk of volatility in the market as a whole. Right? So the stock market is going to respond to things like, changes in interest rates, changes in inflation, recessions, war. So we call these exogenous shocks. You can diversify away all of the unsystematic risk by having a diversified portfolio, right? And if you do, then you're left only with the systematic risks. And then we look at risk, right? We look at an asset's total risk via the standard deviation of its historical returns. But we can look at an individual asset's systematic risk by looking at how it correlates with the market, right? Because the market has, is sort of our definition. The market risk is sort of our definition of systematic risk in the market as a whole. And so any asset, you look at how it moves when the market moves, and that correlation of an individual asset with the market is what we call beta. So what's your stock's beta? That's the finance lingo that I was referring to at the beginning of this. Now, a smaller beta means that an asset moves less than the market. And conversely, a larger beta means that the asset moves more than the market in response to these exogenous shocks, right? And so we have an example here. If the market goes down by 5% and your asset goes down by 3%, then the beta is going to be less than 1. But it's still going to be positive because your asset is moving in the same direction as the market. Okay, so that basically is my summary of what we're doing here in section 8.8. And they give you a little numeric example of, another weighted average to determine what the beta is of a portfolio. Again, I'm going to do all the numeric stuff for this chapter, most of the numeric stuff for this chapter in the context of the practice problems. The bottom line is how much your stock moves relative to changes in the market, right, is a measure of risk and of conservatism, conversely, so risky versus conservative investment portfolios. So if your investment portfolio has a beta of less than 1, then your investment portfolio is somewhat less risky than the market. Okay, so that's what beta is. Beta is a measure of risk, assuming that you've already diversified away all of your unsystematic risk. Okay. So now we're able to move on to the big reveal at the end of this chapter, the capital asset pricing model. The capital asset pricing model is fairly complicated in the real world, and it's the version that we're getting here is sort of a somewhat watered down version. But basically what the capital asset pricing model relies on a couple of sort of concepts. There is the idea that the return on an investment can be broken out into two parts. The first part is the risk-free rate. So a certain amount of the return on an investment is just the value of time. Just the value of just not getting your money today, but waiting for however long. And we generally use 10-year government bonds as a proxy for the risk-free portion of the return of an asset. And there is a risk premium for each asset in the market that is going to be defined in the market as a whole. And the risk premium becomes the slope of a line which shows us the relationship between the expected return and the riskiness, or beta. And so then we have a statement of the equation for this line that says that the expected return on an asset, right, the X value on this line, is the risk-free rate, which is the intercept, plus beta, which is a measure of the risk, times the difference between the market return and the risk-free rate. And so here is the equation that I just explained in words here. Here it is in mathematical notation. So again, we say the expected return of an individual asset equals the risk-free rate plus the expected return of the market minus the risk-free rate times beta. And so this is the capital asset pricing model. And each stock in the market, after it has developed some history, has an expected beta. And so if you look up, betas for different stocks, this is a quantitative stock trading company, ABG Analytics. And, so they're saying that Apple has a beta of 1, and Adobe has a beta of 1.03, AIG 1.56. All right, so AIG, American International Group, they are a insurance company, so they are more volatile than the market. Bank of New York, more volatile than the market. Bristol Myers, less volatile than the market. Berkshire Hathaway, less volatile than the market, right? Beta below 1. Right, so each asset has a beta associated with it. Each stock has a beta associated with it. And so if you know the risk-free rate, which is today's rate for a government bond, and you know the beta, then you only are left with 2 estimates that you need to come up with. So if we want to talk about, remember I said that at the beginning of this would be what we use to price stocks, but it's still not particularly clear, right, how this is used to price stocks. We have an expected return that is based on a known risk-free rate and a known beta, but we have an expected return of the market as well. But this expected return, once we get it, that becomes our discount rate that we use to discount the expected dividends and the appreciation of the stock, right? So again, you've got a whole bunch of things that you're still relying on expectations for. So we are, looking at an expected market return going forward. We are looking for the expected return of the asset based on this expected market return. And then we use that expected return to discount the expected dividends and the expectation of the appreciation of the stock. So it still relies on expectations for the cash flows. But what makes this model superior to the dividend models is its rigor in the development of the discount rate, which again is the expected return. And what that does is it allows investors to evaluate the market price of an asset based on what they think is going to happen to the price of the stock. And then given what they think is going to happen, is today's price reasonable, or do you think it's underpriced? So there is still obviously a lot of uncertainty in the stock market, what's going to happen, and we are in a period of extreme volatility in general, although a general upward trend. I also want to note that the CAPM, while superior to the dividend pricing models, there are additional alternatives to the CAPM in terms of stock pricing. And then the other thing is that the development of high-frequency trading has really kind of messed with some of the economic underpinnings of market prices. And so, what I would close this with is diversification and being realistic about your risk profile is the key for individual investors. And then if you are interested in a career as a trader, that relies on a level of expertise that develops over time and that anyone in these classes is more than capable of developing. But the market as a whole is quite efficient in terms of its ability to incorporate investors' expectations. And the likelihood of any individual investor beating the market is, it's just a matter of luck. So that's what we have in the world of stock valuation and capital asset pricing model. The next video I will show you how to do some of the quantitative examples in your homework. And we will move on in the next unit to capital budgeting.